Deposit money banks are reinforcing their capital buffers as the Central Bank of Nigeria shaping its oversight, deepening governance structure and strengthening risk management system to keep the financial sector stable and resilient. Welcome to Business Point, where we extract the Nigerian economy and the government policies. I am Kike Lomo Ukeri. Nigerian banking system continues to serve as a major anchor of economic stability, but the Central Bank of Nigeria remains alert to evolving threats ranging from cyber risk to credit concentration, pressure, and operational weakness. These risks are being addressed through stricter risk-based supervision and the ongoing transition to Base 3 framework, which aim to improve capital quality, enhance resilience, and strengthen liquidity monitoring as the recapitalization program advances. The sector is currently navigating one of its most defining period. Despite mounting challenges, the Monetary Policy Committee maintains that the industry remains sound, with financial indicators staying with regulatory threshold. The committee has also acknowledged steady progress in the recapitalization exercise, noting that several banks have already met the revised capital benchmarks with less than 4 months left in the recapitalization window. The CBN insists that the process is firmly on track. Many banks have already hit or surpassed the new capital threshold, while others are progressing steadily towards the March 31, 2026 deadline. So far, 27 banks have raised new capital through public offers and rights issues, and 16 institutions have fully met the new requirements, an indication of the depth and capacity within the sector. To safeguard the estimated 4.14 trillion naira in fresh capital flowing into the banking industry, the CBN is overhauling the sector credit risk framework. The regulator is enforcing stronger governance, improved transparency, and firmer accountability to ensure discipline used for new funds. A newly established compliance department now oversees financial crime monitoring, market conduct, corporate governance, enterprise security, and environmental, social, and governance compliance. The credit risk management system has also been upgraded to a web-enabled platform that integrates with banks' internal system, improving efficiency in borrower checks and statutory reporting. A Deloitte assessment project that banks will raise over 4 trillion naira before the end of the recapitalization cycle, describing the increase in minimum capital from 50 billion naira to 500 billion naira, depending on the license type, as essential to help the sector absorb economic shock from inflation, currency instability, and high interest rates. The firm notes that larger capital buffers will equip banks to take on bigger risk and broaden their loss-absorbing capacity. The CBN is also pushing broader operational reform to enhance efficiency across the cash management ecosystem, from production and distribution to consumer access. Measures include updated ATM to guidelines, closer monitoring of branch and ATM closures, penalties of non-performing ATMs, and improved supervision of POS agents. This intervention aligns with the Nigerians' ambition of achieving $1 trillion economy by 2030. A target requires a well-capitalized, technology-enabled banking sector. Under the recapitalization plan launched on April 1, 2024, minimum capital requirements were raised to 500 billion naira, 200 billion naira, and 50 billion naira for commercial banks with international and national and regional license, respectively. The CBN adopted a narrower definition of capital restricted to pay up capital and share premium, ensuring banks must secure fresh inflow rather than relying on reserve or retained earning. Despite the tighter regulatory environment, the banking system remains strong. Non-performing loans are within the 5% prudential limit, and liquidity level exceeded 30% minimum requirement. Recent stress tests reaffirmed the sector's overall robustness. Regulators, industry leaders, and economists agree that the recapitalization is essential to support economic expansion, especially the financing needs of SMEs, large-scale infrastructure, innovation, and digital financial inclusion. By law, the CBN is mandated to maintain financial system stability. Analysts warn that instability in the banking system can damage public confidence, disrupt savings and investment inflow, weaken the monetary system, and trigger broader economic downturn. Over the years, the CBN has implemented reforms to strengthen banks, improve access to finance, and uphold strong corporate governance efforts that continue to evolve under the current recapitalization drive. The CBN tighter control, updated risk management framework, and operational reform are designed to prevent past boom-bust cycles and ensure disciplined use of the fresh capital. With over 4 trillion naira expected to be raised and several banks already meeting a new threshold, the industry appears to position to withstand economic shock, expand credit, and finance Nigeria's long-term growth target, including the ambition of reaching a $1 trillion economy by 2030. Nigerian foreign trade continued its upward momentum in the third quarter of 2025, with the country posting a trade surplus of 6.69 trillion naira, a strong 27.29% increase compared to the same period in 2024. The latest figure from the National Bureau of Statistics shows that Nigerian exported goods worth 22.81 trillion naira in the third quarter of 2025, while the imported totaled 16.12 trillion naira, extending the country's streak of positive trade balances. Although the surplus dipped slightly from 7.46 trillion naira recorded in the second quarter of 2024, analysts maintain that the overall trend reflects the impact of ongoing economic reform, adjustments in the foreign exchange market, improved trade liberalization, and currency repricing have boosted export competitiveness and encouraged local production. Experts note that the weaker currency has made Nigeria's exports more attractive globally, helping manufacturers, agro-processor, and resource-based industries strengthen their presence in the international market. At the same time, the rising cost of the import has pushed businesses to rely on more locally sourced inputs, accelerating backward integration across the key sector. Despite short-term disruption, short and insecurity in some production hubs, logistic constraints, and policy changes affecting specific commodities like shared products, the broader outlook remains positive. The data shows a steady shift in Nigerian trade structure. Agricultural imports increased to 1.10 trillion naira. Raw material import rose to 2.02 trillion naira, while manufactured goods accounted for 7.77 trillion naira of total import. On the export side, crude oil maintained its dominance at 12.81 trillion naira, followed by the petroleum gases and manufactured products. Raw materials exports surged sharply to 1.04 trillion naira, even as agricultural exports slipped to 786.62 billion naira. India, Spain, France, and Netherlands, as well as Italy, emerged as Nigeria's top export destination for the quarter, underscoring strong demand from major global markets. Stakeholders says this pattern points to a gradual realignment of trade activities in line with national policy objectives. Nigeria's trade surplus shows that recent economic and FX reform are reshaping trade behavior. A weaker naira has boosted export earnings and reduced the appeal of imports, pushing firms towards local sourcing and backward integration. While pockets of instability persist, the overall direction signals improving competitiveness, strong non-oil export prospects, and a trade structure that better supports long-term economic growth. Nigeria boasted one of the strongest month-on-month production increase among OPEC members in November 2025, lifting crude output to 1.436 million barrels per day, up from 1.401 million barrels per day in October. The latest OPEC monthly oil market report shows that the country added 35,000 barrels per day, its biggest jump in recent months. Despite the improvement, production still sits below Nigeria's official OPEC quota of 1.5 million barrels per day. The rise, however, reflects steady progress in restoring upstream capacity, improved security around critical assets, and renewed optimization efforts at major terminals. November output marks the fourth straight month Nigeria has operated below its assigned quota. Production slipped sharply in August and September due to maintenance shutdown and labor disruption, before stabilizing again in October and November. The gradual rebound highlights the continued struggle to climb back to full quota compliance. The government maintains that Nigeria allocated quota no longer mirrors its actual production potential and plans to push for an upward review to at least 2 million barrels per day. Official argues that once operational bottlenecks and security pressure ease, the country can deliver significantly higher volumes across the wider OPEC family. Overall, crude production remained relatively flat in November, rising by just 39,000 barrels per day to 25.17 million barrels per day. Saudi Arabia posted the largest increase of 48,000 barrels per day, bringing its output to 10.05 million barrels per day as it continued to shoulder the bulk of the voluntary supply adjustment within the group. Several other producers recorded modest gain. Libya added 14,000 barrels per day to reach 1.365 million barrels per day, while Kuwait and UAE saw a small uptick of 10,000 barrels per day and 8,000 barrels per day respectively. Venezuela extended its slow recovery path, adding 10,000 barrels per day to its 1.142 million barrels per day. Iraq, however, registered the most significant drop, trimming 40,000 barrels per day to settle at 4.1 million barrels per day. Amid pressure of the comply more strictly with agreed production limits, Congo also posted a small decline of 8,000 barrels per day, bringing its output to 269,000 barrels per day. Iran, Gabon, and Equatorial Guinea did not provide data for the month. The Dangote Petroleum Refinery has taken delivery of its second crude oil cargo from Ghana, marking another shift in its sourcing strategies as the plant reduces reliance on European supply and reshape its crude slate ahead of a major maintenance activities. Industry data shows that the latest shipments, Ghana's Sankofa grade, arrived in November, making it second time the refinery has sourced crude from the country. The move aligned with expectation from the refinery, which will continue to prioritize Nigeria and West Africa grades, which offers shorter delivery times and flexible schedule as the facility prepares for multiple shutdowns. Crude intake into the refinery averaged about 380,000 barrels per day between September and November, roughly 30% below July and August peak. The reduction reflects operational hiccups, including recurring outage and a planned 2-month shutdown of the residual fluid catalytic cracking unit that began on December 4. A 1-week outage of the crude distillation unit is also scheduled for late January as the refinery cuts runs. Purchases from Europe, particularly the Mediterranean and the North Sea markets, have dropped sharply, opening more space for domestic grades. November receipts were dominated by Bonny Light, followed by Amenam, Focados, Utapet, and Ukaibo. Ghana Sankafos formed the only non-Nigerian component of the slate. The decline in crude run is also already influencing Nigerian downstream markets, with the RFCC offline unit offline until February. Petrol output at Dangote is expected to fall to about 80,000 barrels per day, down from 100,000 to 130,000 barrels per day in previous months. This drop has widened the supply gap, prompting a surge in fuel imports. Nigeria's petrol imports nearly doubled in November to 300,000 barrels per day, the highest in more than a year, with supplies coming from Europe. Despite reduced operational capacity, the refinery has pledged to keep the domestic market stocked through the December and New Year period. It's committed to supplying 1.5 billion liters of the petroleum in December 2025 and January 2026, with daily deliveries of around 50 million liters. The refinery plans to raise output further in February as more units come back online. All right, let's take a quick short break now. We'll be right back. Don't go away. Stay with us. Welcome back. If you just join us, it's Business Point, where we extract the Nigerian economy and the government policies. The Nigerian exchange saw a subtle but meaningful shift in sentiment on Thursday as insurance stocks outperformed their banking counterparts, reflecting growing appetite among retail investors for low-priced, fast-moving equities. Banking stock remained largely muted. United Bank for Africa and Zenith Bank slightly, with modest losses of 0.62% and 0.08%. Trading volumes were active. UBA moved to 5.73 million shares across 693 deals, while Zenith Bank recorded 20.33 million units in 948 trades, but price movement stayed weak. Other lenders, including EcoBank Transitional and Fidelity Bank, also edged lower, while GTCO dipped by 0.44% overall. The banking sector posted a market capitalization of 1.66 trillion naira with 55.74 million shares exchanged. In contrast, insurance stock drew stronger retail interest. Nifem Insurance led the rally with 6.60% gain to close as 26.65, followed by advance in Regents Assurance, Prestige Assurance, Sovereign Trust Insurance, and ICO Insurance. The sector recorded 47.07 million shares in 1,236 deals, an unusual strong showing that underscores investors' preference for low-priced, higher turnover opportunities. Other financial institutions delivered a mixed performance. Access Holding declined by 0.49%. FBN Holding slipped to 1.10%, and United Capital and FCMB posted slightly losses. Still, the subsector traded more than 82.4 million shares, signaling sustained activities even amid price moderation. Beyond financial, the broader market witnessed pockets of strength. MTN Nigeria led telecoms with 4.91% climb, while Legend Internet jumped to 8.91%. Consumers goods stock also staged notable gain. Nigerian breweries advanced 7.57%, PZ Cotton surged by 9.36%, and Beja Paint rose to 9.88%. Blue chip counters such as Boa Food and Guinness Nigeria were unchanged. Industrial and oil and gas player, including Dangote Cement, Seplat Nigeria, their holdings traded steadily without major price. The all share index closed higher, supported by strong performance of insurance, telecoms, and consumers goods equities. The pattern suggests that investors, especially retail traders, are gradually shifting away from expensive banking stock in favor of more affordable liquid options as they navigate a volatile market. Today, trading shows a clear tilt towards value and accessibility, with banking stocks struggling to gain momentum. Retail investors appear to be rotating into cheaper insurance and consumers facing equities that offer quicker entry points and potential short-term upside. If this pattern persists, the market could see a broader rebalancing towards sector with lower barrier to participation and stronger liquidity. All right, still on stock market before we call it a wrap today. The Nigerian stock market bounced back sharply on Thursday, adding 694 billion naira in strong reversal after days of losses as investors re-enter the market and push key sector into positive territory. The all share index climbed to 0.74% to 147,950.59 points, lifting a year-to-date return to 43.74%. Insurance stock led the charge with 2.99% jump, while premium and consumers goods stock also posted solid gains. Despite a dip in overall volume, and number of trade activities remained strong, driven by high liquidity counter. Access holdings dominated the session with over 156 million shares traded, followed by FCMB, Fidelity Bank, Gelpol Gold, and Zenith Bank. On the gainer chart, Beja Paint and Gelpol Gold surged nearly 10% each, while Morrison Industry and PZ Cotton also advanced. John Holt topped the losers list alongside Champion Breweries, Etana, and VFD Group. The rebound signals renewed investors' confidence, with retail players shifting towards resilient sectors such as insurance, telecoms, and consumer goods after a volatile trading week. The momentum suggests a cautious but growing appetite for value and liquidity as the year-end approaches. All right, this is where we draw the curtain on Business Point this week. Join me again on Monday on Global Television, channel 365 on DSTV and 276 on Star Times. To stay connected, kindly follow us on all our social media platforms using @GlobalTVNG. Till I come your way again, I am Kike Lomo Okeri. I celebrate you all.